I honestly do not think that we have too much time left. Cue the fire. And the good news is I am bringing someone on to explain the craziness rather than stories that I can't line up. But I think we are approaching biblical times. In the next couple of weeks, that's when those biblical times start, and it goes for 1 year. So buckle up your seatbelt. It is going to get bad in about 8 seconds. Don't you just love counting clocks? There we go. Time's up. Okay. Whew. That feels good. You want to know what else feels good? Hitting that thing. Try it out. It gives you little squigglies inside your belly. A growing number of traders, academics, and bond market gurus. Hey, wouldn't it be a great idea if I could get Steven Van Meter on today? I think I will. Just hold your horses. Are worried that only 24 trillion market for U.S. Treasury debt could be headed for a crisis. Oopsies, as the Federal Reserve kicks off its quantitative tightening into high gear. Well, that would be this week. So Steven will come on and tell you how bad it's going to be. And I'm going to tell you, it's going to be really bad. But he'll explain. With the Federal Reserve doubling at pace, at which its bonds holding will roll off its balance sheet. What does that mean? Well, it will be explained to you momentarily. Some banksters and institutional traders are worried that the already thinning liquidity in the Treasury market could set the stage for an economic collapse. And then you say, well, how bad will it be? Well, I'm glad that you asked. So I'm bringing Steven on. We're going to banter back and forth. So buckle up, Buttercup. All right, guys. So I got Steve here. We are going over how this entire thing's just going to end in a gigantic dumpster fire. Hey, Steve, and for those of you that don't know, this is Steven Van Meter. Head over his channel, like, subscribe, share with your friends, do all those clickety clacks. But we're going to talk about kind of like, how does this end? Like, what are the things that we can look for when it comes to the stock market? We'll talk stock. We'll maybe throw in a little bit of gold. And then everyone gets to throw rocks at my face. Steve will be safe because he's on the other side of the screen. So what do you think, Steve? Because off air, we always talk like, wow, when this thing breaks, like, or these are what we can see happening. So shoot, what do you see?
Yeah, this is clearly the case of the Fed. So we've got 75 basis points, high probability coming next week. And that's not really the thing that I get too concerned about. I mean, rate hikes alone, okay, big deal. I mean, they're going to keep doing it. It's the quantitative tightening that doubles here, on Friday. And so that essentially is going to hit the markets till the following week. So people say, well, I mean, it didn't do anything. Well, that's because the trades have to settle. And what we've seen already is, if we factor the QT as a big reason the markets are down, we're going to double that pace starting this month. And the 15th to 30th is when those roll-offs hit. And then we're going to have the following couple months. And that's going to have big ramifications. I mean, we could see a bear market here, JB. I mean, I know I'm going to go out here on this one with you. I think we could get down as low as, I'm looking at my charts, the March 2020 lows.
Ooh, that's ugly. All right, everyone, run out there, right click. It's the sell button. You click that, not financial advice. You can make money going up and you can make money going down. Can you explain to my audience as if they are a kindergarten? I know QT and QE completely different. Everyone thinks it's just the same thing, just opposite, but it's not.
No, they're not.
I know. You're like, get me going. But make it real simple, because we talk all the time, and I'm like, okay, I'm 5. So give me the breakdown of QT and how it affects my portfolio.
Yeah, so let's just quickly touch on QE to understand the differences. So when you deposit money in a major commercial bank, it could, when I say commercial bank, I'm talking the Bank of America, so Wells Fargo, Citibank, JP Morgan. When you have a deposit there, the bank's going to do one of two things with it. They're either going to lend it out. That's their ideal thing that they want to do. The alternative, if they just don't have the lending demand, or they have just more deposits than they have ability to lend out, they will buy and create what's called a bank reserve. And the bank reserve is nothing more than buying a U.S. Treasury or a mortgage-backed security, something that is backed by the government. That's all they do. Now, when the Fed does QE, they come in directly to the bank and they buy them. So what happens when you see QE happening, they're effectively forcing the banks to stop lending. We actually see that in the data. The banks curtail their lending because the Fed's buying all these bonds. Now, the idea that this is just a simple reversal isn't quite the case, because the Fed said, we're not going to sell anything off our balance sheet. And to sell would be the exact opposite. Instead, JB, what they're going to do is they're going to let these securities mature, which is why the 15th and the 30th are the key dates every month, because that's when the auctions are happening. That's when the maturity dates are, is on the 15th and 30th. Now, when the Fed gets the cash back from the Treasury, they're going to hand it back to the bank, because guess what that cash really is? It's your deposit. That's what people don't get. It's your deposit. So now the bank gets the cash back, and now we go back to square one. We have one of two choices. Either we're going to lend against it, or we're going to buy a Treasury security again. So how does this actually pertain to the markets? Well, it could effectively, as way it appears, is it pulls liquidity out of the market when the Fed does quantitative tightening. It constrains what the banks can do and a number of other market makers, primary dealer banks. You're looking at dealers, and it just constrains their liquidity. And when that happens, well, usually you see markets go down, and that's kind of what we've been seeing, is every big surge in stock somehow just seems to run out of steam. But back in the QE days, boy, I mean, you let that kite out, it kept going and going and going. Now, not the same.
I thank you for sharing that with everyone. I already knew that. I like to have someone else. Same thing when we talked back in the day, like, where's money come from? It's like, well, it's loaned into existence. Like, people cannot get their head wrapped around that. So just real quickly, just to reinforce what I've been sharing with my audience for the last umpteen years, Steve, where's money come from?
Money is created in the commercial banking system, whether it's the domestic banks or in what we call the Eurodollar system. The Eurodollar does not have anything specific to do with Europe or euros. It's referred to any dollar deposit outside the U.S., could be in Mexico, Canada, anywhere. Well, commercial banks outside the U.S., lo and behold, have the ability to originate dollar-denominated loans. So any commercial bank around the world can create dollars, with the exception of countries like China, obviously Russia, their banks don't have that ability. But that's where money's created. It's created when people borrow money. And what's interesting, JB, is what did we hear during the pandemic, that this fiscal stimulus, where did it come from? Even today, people are baffled, where did that money come from? We borrowed it. The U.S. Treasury borrowed billions and trillions of dollars and then turned around and gave it back to Americans. So all the money in existence is completely borrowed.
Thank you for that. Okay, little backstop. Hey, so if you could see my screen, I have I'm sharing the S&P 500. I've covered this before. I have just a couple lines on here. From a technical standpoint, you got this is on the weekly, and this is the 21. We actually had what's called the kiss of death, all-time high. There's one. We come down, we drop. There's your low. We come up here, we retest. We kiss, we fall below. We also have a support right here. I mean, we're just about ready to break. But once it goes below that blue line right there, that is called the kiss of death. We are going very, very, very low. But so you're thinking, if you had to guess, you're thinking on S&P 500, 33. But you're thinking maybe down here, yeah? Down here?
I'm thinking we could see, below 3,000 is what my hunch would be.
Yeah, it's kind of like where we started from during the right? When we pop back up. That's probably, if I were to turn on the 200-day moving average, it's right in that zone.
Yeah, and you're right, that June low is really critical right now, because that is getting bought aggressively every time it came down there. So you're looking at that point, that is a line of sand problem. What I would agree to is, if you see that break, that means people are really losing heart that the market is going up, and would provide validation we are indeed in a bear market, which I think you'll agree that we're in the early stages of. A lot of people still say no.
Yeah. No. We're this is This is the rollover. This is the early stages. Yeah, I know you got a lot of people, media. No, bear market's over. I'm like, no, bear market just started. Talk to Stephen Van Meter. Let's talk bonds for a second. Let's talk about how the Fed really works. But yeah, it's 3,000 for my audience. It's 3,642. You break that line, that is the line in the sand. If you believe in technicals. Now, a lot of people don't believe in technicals, and those people actually lose a hell of a lot of money, but that's okay. You keep looking at your PE ratios. Let's see, what else would you like to talk gold for a moment? We'll shift over. So now everyone knows there's your stock market. Steve's probably pulling up his GLD right now. Also, for those of you that
gold, I have a line in the sand at 1687 on my charts. Maybe it could be slightly lower, but yeah, you break that, go pull up. I tell people, if you want to know where gold's headed, pull up a chart of silver. You see that silver, man, the big, beautiful topping pattern, and then came crashing down. And lo and behold, it looks just like gold. I don't know if you got a chart on that, JB, but if you do,
I have. I do. I'll boy, and everyone buy physical. Don't throw rocks at my face, please. We're just paper trading over here. No need. Yeah, don't shoot the messenger. Boy, did I get a lot of shots fired on this. Was GLD, so I'm not on the big number. I'm at 155. Same thing. This is your paper, not real, kids. Right. The line in the sand on this one was that blue line going all the way back to I think the birth of Jesus. And when we crossed it, I'm like, it's gone, man. And everyone's like, no, this is a perfect opportunity. I'm like, well, you're going to have some more perfect opportunities down here. Look at that. Oh my goodness gracious. So yeah, we're falling. And then, so silver, wait, hold on. Let me just do, cause I know people like, they like their gold. How far? Oof. Oh, that's the 200. All right.
Yeah.
Let me,
yeah, pull up silver.
Yeah, I will. Oh gosh, we still okay. That's Lux Algo. If you guys want it, it'll give you some charting patterns, so you don't have to look like a noob. You can impress your friends, and you're like, look at this channel that we're in. That's a channel. So I turned on Lux Algo, and it's bouncing in this channel. If you've noticed, it's going in that way. I also do like to say whatever, because people say, hey, what's gold doing? What's silver doing? I'm like, well, whatever the dollar's doing, that they would be opposite. So on this one, actually, this is a descending, broadening wedge.
Yeah, zoom out on this one.
Okay. You want me to go?
Look, you see, look at that big topping pattern, right? See that there?
Oh, yeah.
That now, if you look at the same chart in gold, you see something very similar to that. And then when it broke support, it's game over. And that's what I see coming for gold too. I know people are real bullish on gold, and I am long-term bullish on gold, but I've maintained for the short term, which is my opinion on what short term is. It's going to come down. I think 1300 is where it gets to. We'll see if I'm even close on that one.
Okay. So you're down here. Same spot, same area with the rest of the market after the pandemic. So yep. And then we'll fix that little 200-day moving average. We'll pop right back above it, and then we can start buying. Well, as a swing trader, also link in the description. Coupon code for my swing trading course. Start there. Learn how to swing trade, because it's going to happen. We're all going to come down to the 200. We're going to get above it. Make sure right now you're making money on the way down. If you want to, just paper trading. And then we're going to swing back up, and here we go again. Make sure you sell the top this time and not hodl. Anything else, Steve, that is on your radar that you would like to? We went stocks. Okay. We went bonds. We went gold, silver. Was there anything else that you wanted to share with my audience, or maybe give something about, hey, click here on me?
You know, JB, I think you give people great advice when you tell people paper trade. Educate yourself, get the courses, get books, get whatever it is, but don't go commit your real money when there's plenty of systems out there you can just paper trade for a while, get comfortable, and then go put your money in. I think that's great advice, and I hope everyone that's listening that wants to get into trading will follow that.
Yay! Thank you. All right, you guys. Well, thanks for hanging out. Thank you, Steve, for joining the chat show that we're currently living in, and I will see you guys tomorrow.